As I've shared in several of my recent videos, the market recently has been punishing the high yield space due to fears about higher for longer interest rates. On top of that, there have still been some high yield stocks that have actually performed pretty well despite these concerns about higher for longer interest rates. And as a result, I don't think they're nearly as attractively priced anymore. And this is creating a bifurcation of opportunities in the high yield space. And I love opportunities like this because it enables me to sell some of my positions that have gone up a lot and use the proceeds to buy positions that I think are doing quite well fundamentally. They continue to pay high and growing dividends. They're growing their underlying earnings, strong balance sheets, quality business model. But because of interest rate fears or some other concern by the market, they've become significantly undervalued and the market is overreacted in its bearish sentiment. So I'm able to load up on cheap value, hold and wait for the market to recover in terms of its opinion on these companies, and then I can rinse and repeat the process over and over again. By doing that, I'm able to accelerate the compounding process. So in today's video, I'm going to share one high yield stock that I think is fairly valued by the market today and I personally would not be buying, and two high yield stocks that I think are significantly undervalued. In fact, these are not only high yielding stocks, but they're actually growing quite aggressively and have pretty attractive growth outlooks for the foreseeable future. So I hope you'll stick around and listen to what these are. Before I get into what these are though, if you could please subscribe to my channel, help me to grow my outreach to make these videos more worthwhile, help me to even have more resources to put into them to make them more attractive. I put out regular dividend content, some of my top picks and ideas multiple times each week. Thank you so much. Okay, so which stock am I steering clear of right now? It's Altria. Now I know Altria is really popular, especially with retirees. It has a 7.5% dividend yield roughly as of this video shooting. It's a dividend king. It's grown its dividend every year for over 50 years. Okay, you combine those two things, it's like, okay, enough said, sign me up, right? Well, not so fast. Now, yes, I don't think Altria is like a big sell or anything right now because that yield is probably going to be safe for at least a while. And again, that dividend growth track record, what's not to like? It is a very defensive business model due to the addictive nature of its core smokable products. People smoke because they're addicted, not because they have more money than they know what to do with. And so even if we go into a recession, again, the vast majority of people are going to continue to buy cigarettes and smoke them who are currently addicted to them regardless of whether they can afford it or not. Now, why am I not so bullish on Altria then? Well, first of all, the growth has been slowing rapidly, and that's largely due to the fact that volumes are declining at a very rapid rate in its core business because smoking is largely a habit for an older generation. Younger generations have different vices, you could say. And so this older generation dies off slowly. So does demand for Altria's core smokables product. Now it's been trying to expand into vaping and some of these other adjacent businesses with mixed results. But the biggest issue for Altria is, well, the twofold. One, it's concentrated in the United States. And again, the U.S. smoking is taking a much bigger hit than it is in some of the other areas because it's a growing, increasingly health conscious. You know, both my grandfathers died of cancer due to their smoking. One of my grandmothers did as well. I think many others have similar experiences. And so that knowledge in the back of my brain, I have no desire to ever try smoking. And I think many others have. Now, again, this video is not an anti-smoking campaign. That's not what it's here for. But I think that's just an important reality to keep in mind that smoking as a habit is on the way out in the U.S. and in its culture. And so, again, Altria is having to try to find a way to expand outside of that. It doesn't have international markets to diversify into, at least at this point, at least it's been able to do successfully in a meaningful way. And so what is it doing? Again, it's throwing money at these different investment projects, hoping that something will stick, like Juul, which was a massive multi-billion-dollar disaster for shareholders. It's been buying back stock, sometimes at not the best valuations. It's put on a lot of debt on its balance sheet as a result. Now, its balance sheet is still okay, but it does have a lot of debt, and so it only has so much more capacity that it can tap into on that front. Oh, their earnings are going to plummet overnight. I don't think they are because, again, their core business is stable. They're able to consistently raise prices on those cigarettes because of the addictive nature. People will pay more even if they can't afford it because, again, they're addicted to these products and highly loyal to them. So that helps to offset some of the bleeding from the volume declines, although, again, there's only so far they can go with that. But what's the other piece here is that even if they are replacing some of these lost revenues and earnings with these adjacent investments, they don't have nearly the moat, they don't have nearly the profitability and the stickiness that their core cigarettes business has because, again, these other products are not nearly as established. The brand names are not as established with, a young person who's going to try an Altria smokable, a vaping product or something like that. Doesn't have nearly the loyalty and the built-in addiction that someone who's been smoking Altria cigarettes for 30 years, 40 years has. And so, again, it's a narrower moat. It's probably going to be much lower, tighter margin product because of the competition, the lack of established competitive positioning. And so at a minimum, it's transitioning from a wide moat business to a really no, or at best narrow moat, but probably no moat business in many cases. And so as a result, I see the quality of the earnings declining, the quality of the business declining over time, which could lead to a valuation multiple compression, ultimately put dividend under pressure as well. Analysts are only expecting, on top of that, only about 3% growth at best over the next several years. And so when you combine that with the dividend, sure, it's going to be about a 10% annualized total return, which isn't bad. I don't think it's a sell, but I don't think it's particularly attractive as a buy, and I think it's pretty hard to make a case for meaningful valuation expansion from here, given that the fundamental underlying business model is likely going to deteriorate moving forward. Okay, so what about the two stocks that I like right now? Well, one of them is Clearway Energy. And what do I like about Clearway Energy? Well, it currently yields about 7%. The stock price has gotten hammered down, and so it has a very attractive current yield. It has a defensive business model because the vast majority of its cash flows come from long duration power purchase agreements with investment grade counterparties, many of them utilities. And so again, very recession resistant. It also has a solid balance sheet with corporate leverage ratio between 4 and 4.5 times that it's been able to sustain. It's retaining a lot of cash flow, which it's reinvesting in the business to grow by buying new assets that drop down from its renewable power parent that give it, windmills, solar farms, and other investments that it can invest in for stable long-term growth. And it's able to pay out its dividend on a growing basis. And so you combine the 7% yield with expected between 7.5% and 12% annualized cash flow per share growth through 2027. And after that, they're expecting to grow between 5 and 8% annualized rate on the same thing. So if you combine those attractive growth rates with that 7% plus current dividend yield, you're already getting to a mid to high teens annualized total return. On top of that, the balance sheet is expected to remain between 4 and 4.5 times levered on a corporate basis, which again is a very sustainable, reasonable level. And they have minimal need to access equity markets to achieve those growth rates. And so that makes them quite resilient to capital market conditions, unlike peers like NextEra Energy Partners, which are having a hard time because they need to generate a lot of equity capital to deal with financial obligations in the near future, but their cost of equity is shot, and they're obviously susceptible to higher for longer interest rates as well. So I think Clearway delivers an attractive yield, an attractive growth rate, a defensive business model, and is relatively resistant to a higher for longer interest rate environment in terms of its capital markets needs. Now, the second stock that I really like right now is MPLX. Now, it does issue a K1. It's a midstream MLP, but it is totally worth the K1 if you just study what the company offers. It has a distribution yield of over 8%. It's well covered by distributable cash flow. It's been growing its distribution every year very consistently, even through the COVID crash. Has an investment grade BBB credit rating from S&P. Has a very defensive business model that's diversified and has exposure to both oil type commodities as well as natural gas. Has a strong backing from Marathon Petroleum, which is a quality energy business that is a large counterparty of it, also owns a lot of its units, so it's well aligned with unit holders. And management has guided for 12.5% distribution per year growth for the foreseeable future. And I think at a bare minimum, it's sustainable around 10% per year for quite a number of years to come. And so again, you get that high yield, high growth with a strong balance sheet and a stable cash flowing business model. Again, what's not to like? I think on the recent dip to push the yield back above 8%, it's a compelling buy. So again, hopefully this video added value to you. If it did, please subscribe to the channel, give it a like so that I can continue, this video can get better distribution. I can continue to grow my channel, and let me know in the comments what you think of these opportunities, as well as what you think of Altria right now. Thank you so much. See you next time.